Today, the stress is showing. The DFA daily to the 27th of April 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. NAB surprised the market today by bringing forward their first half 20 results, going into a trading halt and raising more capital, with earnings, excluding large notable items, declining 24.6% to $2.471 billion, relative to the first half of 2019. Income was down, especially in markets and treasury, down 31% in fact as a result of $160 million unrealised losses on NAB's HQLA portfolio and a negative derivative value adjustment in the half, down $86 billion. In management comment, they did say that the elevated levels of volatility had led to trading being stronger, with April month-to-date revenue tracking at around $300 million compared with a half of $578 million in markets and treasury overall. Net interest margin was flat and better than expected, helped by very low domestic wholesale funding costs, which helped to offset higher term deposit costs. The first half bad and doubtful debt charge was 38 basis points of total loans, but the collective provision was up 35% to $4.4 billion and includes a $807 million collective provision adjustment for COVID-19. NAB now expects financial year 20 Australian business lending growth of somewhere between 13 and 16%, noting it expects limited capital implications as the growth mostly relates to drawdowns where capital is already held. In a letter to shareholders, the bank was keen to underscore their support for businesses and households. For our customers, they say, we've already taken firm steps, including allowing home loans and business loan customers impacted by the virus to pause repayments for 6 months, providing impacted businesses with low-cost funding as a bridge through the uncertainty, lowering interest rates on home loans and other products, and removing many fees and charges, putting more of our colleagues into customer-facing roles so they can work with those customers that need understanding of what's going on and to help them try and find a sustainable path forward. The vast majority of our colleagues, including, they say, our customer-facing service teams, are now working from home. And they said, while we are here to support every business customer, we will be honest and upfront with those who struggled before this crisis that their operations may not survive it, with or without our support. It is the responsible thing to do. And they are bolstering their capital base through a fully underwritten institutional placement of $3 billion and a non-underwritten share purchase plan targeting to raise around $500 million. Eligible shareholders will have the opportunity to participate in the share purchase plan later. Hence the trading halt. They reduced the 2020 interim dividend to 30 cents per share and acknowledged that this would impact their investors. These actions, they say, are intended to provide the bank with sufficient capacity to continue to support its customers through these challenging times, as well as increasing capital levels to assist to manage through a possible range of scenarios, including a prolonged and severe economic downturn. And the board and senior management have decided to cut the elements of their remuneration. Now, I think this will all be the playbooks for a number of the banks in the weeks ahead. But banks in Australia are fortunate to have such a supportive environment from both government and the RBA at this time. For example, Banking Day says that the Australian Office of Financial Management has engaged legal and consulting services to assist in the development of the Forbearance Special Purpose Vehicle that's being designed to compensate for deferred cash flows in securitisation structures. The AOFM is working with the Australian Securitisation Forum to come up with a structure that would give the Structured Finance Support Fund the option of investing in outstanding RMBS asset-backed securities and warehouse facilities sponsored by non-ADIs to compensate for cash flows deferred as a result of repayment holidays. The ASF sent the AOFM a draft term sheet for the forbearance special purpose vehicle earlier this month, and on Friday the AOFM announced that it has called in lawyers Clayton Utz and consultant Emptor SD Services to work on the project. The idea of the forbearance SPV is to advance funds to eligible securitization trusts and warehouses that wish to draw liquidity advances to compensate for the deferred interest component of scheduled payments. The plan is that participants will subscribe for junior notes in the forbearance SPV, and these notes will not cross-collateralize the obligations of other participants. And the Australian Competition and Consumer Commission has authorised members of the ASF to work together on the forbearance model, and it's authorised the ASF and its members to discuss how the AOFM should administer the SFSF, including providing a view to the AOFM about developing measures for issuing new debt, appropriate funding arrangements, allowing for hardship relief, and ensuring the continued flow of funding to smaller lenders. Under the SFSF program, the government is providing the AOFM with $15 billion to invest in structured finance markets used by smaller lenders, including small ADIs and non-ADIs. This support will be provided by making direct investments in primary market securitizations by those lenders and in warehouse facilities, and the SFSF has already made 2 investments in First Max 2019-1 RMBS issue and in a Judo Bank warehouse facility. Now, what does all that mean? Well, in a word, the government is supporting the banks via the back door and suggests to me we may well see the development of a good bank, bad bank strategy where troublesome assets are taken off the banks and held on the government balance sheet. Nice support if you can get it. With regard to the current health emergency, CBA discussed whether unemployment is a useful measure of anything. JobKeeper will mean employees will be paid a salary from the government via their employer, even if they're not working. This will have a profound impact on labour market statistics because of how the ABS defines a person who is employed. Generally, the ABS considers a person to be employed if they have worked 1 hour or more for some form of payment. But there are a few exceptions to this, and JobKeeper will be one of them. More specifically, the ABS has determined that people who are paid through the JobKeeper scheme will be classified as employed regardless of the hours they work, e.g., even if they are stood down and do no work. Historically, to be considered employed is to receive payment for work, but in essence, the accounting of JobKeeper means to be employed is simply to be paid. There will be a very large number of people receiving JobKeeper who will not be turning up to work over the next few months because their employer is shut. For example, a lot of employees will be working 0 hours a week. But despite not working, they will be considered employed in the ABS Monthly Labour Force Survey. According to the ABS, to be classified as unemployed, someone must first not be employed during the reference week and 2, have actively looked for work and be available for work in the reference week. The key is actively looked for work. The ABS defines actively looked for work to mean that someone has done at least one of the following: written, telephoned, or applied to an employer for work, had an interview with an employer for work, answered an advertisement for a job, checked or registered with an employment agency, taken steps to purchase or start your own business, advertised or tendered for work, and contacted friends or relatives in order to obtain work. CBA expects that a large number of people will have lost their job but will not be actively looking for work while out of work. These people are still eligible to receive Job Seeker despite not looking for work. Indeed, the ABS states that people who receive the Job Seeker or other similar government payments are not necessarily classified as unemployed. And they also note that recent changes to the Job Seeker program as a result of COVID-19 means that recipients do not have to meet the usual mutual obligation requirements, such as looking for work. Currently, for a lot of people who have just been displaced, there is no incentive to look for a job because there are no job openings in their area of expertise. If someone lost their job, for example, as a bartender, there is no point looking for another job as a bartender while pubs and hotels are shut. The increase in Job Seeker will also serve as a disincentive for people to look for work, particularly given the lack of jobs on offer. The Job Seeker payment has been doubled from its previous $550 a fortnight to $1,100 a fortnight. For many people that will lose their job, it will simply make more sense to receive Job Seeker and wait for the shutdown to end rather than actively looking for work while large chunks of the economy remain shut. In which case, despite a person losing their job and receiving Job Seeker, they will not be considered unemployed. This will have a profound impact on the level at which unemployment peaks. And CBA suggests as many as 1 million people will be classified as employed but won't be working any hours. These people will receive JobKeeper but will not be producing any output. That is why total hours worked is expected to plunge and will look vastly different to the decline in employment. The RBA, for example, estimated that total hours worked will decline by around 20% over the second quarter 2020. And they also believe that the fall in the level of employment will be bigger than the rise in unemployment because they expect participation in the workforce to dip. There will be a lot of people who were previously working, lose their job and receive the Job Seeker payment, but will not be classified as unemployed. This will be captured in the participation rate, and their forecast is for the participation rate to drop by 1.5 percentage points to 64.5%, which will see the unemployment rate rise to around 9% on job losses of 700,000. These forecasts imply that around 250,000 people will lose their job, but will not be considered unemployed by the ABS because they will not be actively looking for work. It would not surprise us, they say, if that figure ends up being a lot higher. So they recommend focusing on a range of other indicators that relate to the labour market to more fully understand the dynamics at play over coming months. These indicators include hours worked, the participation rate, the new weekly ABS payroll series, the number of people receiving Job Seeker, and the employment component of Purchase Managers Indices. REB reported that exclusive research has revealed real estate and aviation as the industries suffering the most revenue-wise amid the global pandemic. My Business commissioned Momentum Intelligence to create an ongoing survey of a cross-section of Australian business owners and employees, including those operating in the real estate industry. The COVID-19 Business Confidence Survey encouraged participants across a range of Momentum Media's professional service brands, accounting, aviation, defence, financial services, law, mortgage and finance broking and real estate, to take part in an online questionnaire between the 2nd and the 22nd of April. The survey asked business owners and managers how their revenue to date has been impacted by COVID-19 and how it was likely to be impacted over the next 3 months. Collectively speaking, 52% of total business owners said that their revenue had decreased, 28% said they'd seen no revenue impact, and 14% said it would be too early to tell. Looking towards the next 3 months, 66% of respondents expect their revenues to decline, 14% expect no further impact, and 13% said they were unsure. The flow-on effect of the virus revenue-wise appears to have hit harder in real estate industries than other industries. According to the survey, 67% of real estate business owners responded as having seen their revenue suffer. 15% see no impact, and about the same were unsure at the time. Meanwhile, 64% of business owners in the aviation space said their revenue had been negatively impacted, and business owners in the accounting space were identified as the industry seeing the least amount of revenue disruption, with 40% saying their revenue had been impacted. When it comes to future impact on revenue, 84% of real estate business owners and managers said their revenue would be impacted over the next 3 months. Meanwhile, 10% were unsure, and 3% expect no impact, and 3% expect revenues to increase. And on property prices, the bracket of the market at the top is taking a bath. The Daily Mail reported that expensive mansions with sprawling gardens and breathtaking harbour views have had millions of dollars slashed off their asking prices. Some homes have been discounted by up to $6 million as sellers desperately try to offload their properties in the wake of the virus. Markets have tumbled thanks to the virus, which has seen countries around the world impose travel bans and government strict lockdown measures. Many Sydney mansions were listed months before the virus restrictions took hold, and the new prices reflect owners' desperation to sell. For example, one home in Seaforth in the Northern Beaches was first listed in 2015 for $11 million, but has recently hit the market again. The 6-bedroom house, which has a gorgeous panoramic water views, boasts 4 bedrooms and 6 car spaces, was relisted for $8 to $8.8 million in October before being slashed to $7.75 million in March. And a home in the Woolwich Peninsula on the North Shore has been reduced by a staggering $6 million after originally being listed for $18 million. The stunning home has 5 large bedrooms, 5 bathrooms, and stretches across 1,416 square metres. It has a permanent private jetty, ramp, pontoon, and a boat shed with studio, space above a slipway, and a sandy beach. And a waterfront home in Clareville, which boasts stunning views over Pitt Water, has also been reduced to $5.9 million, $1.1 million below the original asking price of $7 million. The 3-storey home has 4 bedrooms, each with walk-in wardrobes, 5 bathrooms, and water views from their own private balcony. Simon Cohen from real estate agency Cohen Handler said premium buyers are still active in the market because of the 10 to 20% discounts. He said sellers also have more room to play around the asking price and can afford to give discounts on the property. The sellers may have owned the home for 20 years or more and bought them for something like $700,000 and now want $7 million. If they are serious sellers, they can offer more of a discount than sellers of cheaper properties who can't go much lower. And Real Estate Buyers Agents Association of Australia President Kate Bakos said luxury sellers would soon see competition increasing with holiday home sales. Higher price point properties are experiencing more days on market, and we've witnessed some sharp discounting. And an interesting piece from Bloomberg, which underscores again the manipulation of gold. Australia's largest gold refinery has ramped up production of 1 kilogram bars to ease the supply squeeze in the US that helped propel a surge in the premium for New York futures. The collapse in air travel that's grounded passenger jets frequently used to transport gold products and virus-related disruptions to some refining capacity have tightened availability of the regular bars, typically used to settle the COMEX futures contracts. We're producing as many kilobars as we can. We're probably churning out 7.5 tons of them a week at the moment, and we are forward sold well into May, Richard Hayes, Chief Executive Officer of the Perth Mint, said in an interview. A very large portion of those kilobars are ending up as COMEX deliveries. In a chaotic couple of days in late March, the premium for New York futures over the London spot price rose above $70, the highest in 4 decades. The spread has narrowed to around $21 now, yet that still compares to just a few dollars in normal times. The Mint, which reopened a kilobar production line in response to the supply crunch, expects elevated demand to prove only a short-term issue. Arbitrage issues around the COMEX will be short-lived, and I don't see them lasting for months and months, Hayes said. This is an unusual situation where you've got plenty of physical metal, it's just in the wrong form and in the wrong place. While London's gold market trades large 400-ounce bars, historically New York contracts have been settled with 100-ounce bars and kilobars. Gold coin, Minted bar sales in March jumped to the highest since 2013. A separate outcome of the virus pandemic has been an acceleration of the refinery's work to source additional raw material from beyond traditional suppliers in Australia and neighbouring nations, including Papua New Guinea. The Perth Mint has struck new contracts with some North American gold producers and operations in West Africa in the past 12 months to process their mined material, known as DOR. Since supply chains have been disrupted by the virus, more global mining companies have been seeking pacts with the refiner, according to Hayes. We've certainly won some additional volumes out of Africa, and we've got another 3 or 4 contracts that are in the final stages of negotiation now, he said. The facility is also continuing to see strong retail demand for precious metals products in the US and Europe, prompted by investors' concerns over the potential economic impact of the current crisis. For every coin we make, be it gold or silver, we could probably sell 5 or 6 of them, he said. That strong demand will be a little longer lasting, I expect, as people have been quite badly frightened by this whole COVID disaster. And finally, Chief Medical Officer Brendan Murphy has predicted that more than 50% of Australians could take up the new COVID Safe app as the government mobilises a broad range of health professionals to convince people to download the tracing device. The app, launched by Health Minister Greg Hunt on Sunday, will broaden and speed up the tracing of contacts a person testing positive for COVID-19 has had. Fearing many people will shy away from the app because of privacy concerns, the government has surrounded it with what it describes as the strongest ever security provisions. Hunt has made a determination under the biosecurity legislation enshrining protections. There will also be legislation for the app when Parliament meets in May. Data must be held in Australia and not used for any purpose other than tracing contacts for a COVID case. Once a person who has downloaded the app has tested positive, they must give permission before the data on it can be retrieved. Only state health officials will then be able to access the data, and there will be prohibitions on coercing or requiring anybody to install or use the app, whether by positive obligation or adverse consequences of refusing to do so. For example, there is a prohibition on an employer refusing to enter into or continuing a contract or arrangement on this basis, or a person refusing to allow someone to enter premises. Experts disagree about the needed take-up for the app to be effective. In Singapore, the take-up rate was only 20%. The Australian government has spoken of a take-up rate of 40%. So we'll see. So, standing back, you can see that there are many issues still on the boil, but I personally think those relating to the banking sector are the ones to watch. But as I've said before, and I'll say again, I think the banks are very, very fortunate to have such a supportive government and a supportive central bank, because at the moment they are receiving help through the front door, the back door, and through a number of windows too. It's a fine time to be a bank. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.